The alpha miracle is somewhat analogous to a magic trick. When you first see it, it's mesmerizing. However, underpinning this apparently impressive feat, there is a logical and process-driven approach.
Active managers are evolving their quantitative and fundamental analysis processes, evolving their businesses to focus on areas where they can generate alpha. Homogeneous sectors such as utilities, real estate and telecoms are suited to investing on a quantitative basis. The growth in passive investing is being driven by an unbundling of exposures. On the one hand, diversified mutual funds have lost market share, but on the other hand, sector specialists, country specialists and hedge funds have gained share.
Passive investing has been getting cheaper and cheaper, whilst active management costs considerably more and yet provides no guarantee of success. Keen to keep costs below active strategies whilst aiming for returns exceeding passive investments, savvy investors have driven a surge in demand for smart beta, which is a clever middle ground. A rule-based strategy can then be implemented passively and cheaply to capture the desired exposures.
It's not as black and white as active or passive. Technology has driven both market efficiency and a proliferation of choice. Investors can select the exposures that they're happy with at the right price.
Much of what was previously thought to be alpha is in fact returns that are earned from deliberately targeting exposure to specific risk factors. This is why smart beta is referred to as risk premia investing. Perhaps the most exciting area of financial research currently is trying to understand all of the different risk premia and how to combine these into an attractive portfolio.
This really depends on how much money is invested into hedge funds. Active managers are required to keep the market efficient, so actually, it's the rise of hedge funds that facilitates the rise of passive investing. Right now, we think that the market is in equilibrium. However, if hedge funds continue to grow, it's likely that passive investing grows as well.
Expecting to be compensated for taking risk is one of the fundamental concepts in finance. Without that expectation, why would anyone be enticed to take risk? Why would anyone put up with the volatility of the stock market instead of leaving their money safely in the bank if it wasn't for the expectation of higher returns?
The latest research shows active managers outperforming the market, part of an ongoing steady trend. In a nutshell, active managers tend to outperform when dispersion of returns is high and correlation of returns is low. As an aging population drives lower earnings growth, there's an opportunity for active managers to outperform over the next 10 years. We prefer active exposures over passive exposures. Strategies that are likely to perform well are high quality growth, high quality income, country and sector specialist funds, and hedge funds.